Hello everybody, my name is Stefan Friedrichowski and we have the next webinar about the topic developing superb trading strategies in cooperation with Argus FX, a broker of our choice. And yeah, what we like to do is simply to continue our webinar series. This loose series about trading strategies, how to develop, what to be taken into account if you do that, and so on and so on. Always new topics. So for those who might be new here, there's no real beginning and no real end of that webinar series. It's simply all around trading strategies. And before I forget it, for the minutes or for the recordings, we have the 18th of August 2016 and 11 o'clock as always for the English webinar. Yeah, today we have as always 3 topics. First I want to start with some questions of last week. There has been one interesting question which reached me via email. By the way, if you want to get in touch with me, just send me an email at Friedrichowski, very complicated last name I know, friedrichowski@argusfx.com, and we can exchange whatever information is needed. So I might help you with your trading, your ideas, and you will see later in today's webinar that there's an invitation as well, and but that's later. So topics today, question and answers, yes, of course, and the other one is I want to introduce you into the concept of back-forward testing. Sorry that I don't know exactly how to spell that word. That was, by the way, back-forward, how the computer has done it. So I would spell it a little bit different, but anyhow, I think you will learn what I mean with back-forward testing. That is just a concept, and I want to explain it and introduce that kind of concept because I think it's a very valuable concept all around trading strategies, because we can learn about our strategies a lot because we can do a real test in the history, but you will see. Third topic for today is a new trading concept. As always, I strongly believe that there's nothing really new in the concept of trading, but at least it's new for me, and I want to share that kind of concept with you as well, and that is runs at least by me at so-called class trading, because we want to build classes of similar situations, and then we will have a look how we can trade exactly those situations. It's a very interesting concept, and it has many possibilities to be changed, but so yeah, you will see. Let's start with the questions. There was one interesting question. By the way, the question has, or the email has been in German, and I have simply copied the question into my slides here, but anyhow I will translate so that everybody might follow what I have been asked here. The question was around the trading strategy of the last couple of weeks, the DAX EMA trading strategy, which has been optimized. We know the parameters, we know the equity of the past, so we know a lot about what we have done. And now the idea of who has sent me the email, somebody called Christian, was, hey, what about, can we filter this trend following strategy a little bit more by some certain additional indicators, and he mentioned a few, the ADX with some certain values, just to enter trades, yes or no, or seasonality, which we can derive from the past. There are maybe months or days which have a bias for long or for short, which is known, or some other indicator like ADX or the so-called indicator supertrend. All those kind of additional indicators, he suggests to filter a little bit more the DAX EMA strategy in order to improve that strategy by those additional indicators or parameters. And my short answer to that is simply yes, we can apply those additional filters, and I know already the result. The answer, it might be astonishing. Yes, we would improve the performance of that strategy. I'm more or less sure that we would improve the strategy, the DAX EMA strategy. But there's a but, of course, and the but is simply nearly every additional filter will improve the strategy. So nevertheless, I don't think we should do it. Simple answer is, the more filter we introduce, and it's not important which kind, whether it's an ADX or seasonality or whatever, we more go into the direction which is called overfitting. So you might compare it a little bit with what you do daily or weekly on a weekend with the charts. You look to a chart and you draw some lines, you draw some trades into the chart which you think, hey, that have been very good in the past. But the more you do that, you filter exactly those kind of situations in the past where you enter trades which are profitable. And that might be misleading if you do something else for trading strategies. So the limitation of what kind of parameters or the number of parameters we use for our strategy should be as low as possible, because the more parameters we have, and just an example, if we would need an additional parameter like ADX, we might need an additional period, one parameter. We might need thresholds like this 25. So immediately we have two additional parameters. Or supertrend is the same, has at least two parameters. So the number of parameters increases, and therefore the possibility for overfitting increases as well, because we simply cut out of the historical chart exactly those situations which have been profitable. Normally, if I do something like that, then the number of trades goes down, which means the statistics goes down as well. It means we have less trades and less statistics, and that is something I want to avoid. What we can do is we might exchange, for example, the EMA by another indicator, or the ATR that was fixed. What else? So that we exchange indicators, but not add an additional indicator. So that's a story all around additional filters. So in principle, answer yes, it would improve, but it's not my favorite style for developing strategies, to add filters and filters and filters and filters. Okay, so that was one question I would I think it's good to share that kind of information with you as well, because it might be of interest for everybody. But now to the next topic, that is more a methodology, so a concept of how to develop trading strategies or how to test trading strategies. So what we normally do and what we have done, for example, with the DAX strategy, we have had a history. In that case, it was a history of 20 years daily DAX candles. And what we then do is we have a build up a strategy. In that case, it was an EMA strategy, and we optimize our parameters in order to get those numbers for that strategy, which give us a good trading result. And now you know what I mean with good, all in the concept of different key figures. But anyhow, so that is what we do normally. We have a complete history and we do our back testing. We derive our parameters and we would start trading tomorrow. I think if you look into the web or EA backtesting, whatever you find in the internet, everything, at least 99%, is done exactly that way. But we can do better than that, because we can do our developing and testing of our strategy already in the past. Because why not, if you think we have done our DAX strategy for the complete history which we have had, why not stopping the history, for example, in the year 2010 and only going for the optimization process until 2010 and then apply our parameters which we have derived from the period from 1990 to 2010, take that parameters and apply them to the then coming future. So for the years 2011, 12, and so on and so on. And what we even can do is we can do that process iteratively. So that means we can do that back testing and optimization of parameters in a certain historical period and always apply it to the then coming future. I will show it to you with a picture, because that might be easier to understand just on the next slide. But what is the outcome? The outcome is, if we do something like that, that we exactly would know what would have happened in the past if we would apply that kind of logic. So we can do our experiment already in the past, our trading experiment, and not only rely that we have a good strategy and then start trading tomorrow. So the main difference to normal backtesting is simply that the history for optimization is not really part of the backtest. Let me show what I mean. On this slide, there's a chart, and it's not really important what kind of chart, but in this case it's a euro, US dollar time period, whether it is hours, days, I don't care, because the methodology can be explained on any chart. Let me describe what's here additional within the chart. In total, by the way, the chart is from 2007 to 2014. Let's look to the green box, the green window. This green box, I think box is the better name, by the way. This green box indicates a period of, I don't know, maybe it's about 1 year of prices. Within that green box, we now would do that optimization process. This just getting the best parameters for a trading strategy, whatever kind of trading strategy, I don't care right now, but we can go into that green box and we get our numbers for our strategy. But maybe EMA values, stop loss values, take profit values, and so on and so on. So within the green box, we do the optimization process for getting the parameters. Then we apply those parameters to the next coming future, which is indicated with a red box here. So just a few next days, we would apply our strategy to that period. That period has not been part of the optimization process, so that backtesting optimization process within the green box. So from the perspective of the green box, the red box is future. So it's really something like getting a strategy in the year 2007, 2008, getting the parameters, and then apply the parameters to the future. Then the future is exactly, in this case, this red box. The results of those trades within the red box, which are in the future, we would now store. So that will create our equity curve. We don't care about the real equity curve within the green box because that was the optimization box. But we care about all those trades within the red box, so the future box. So those come to the records of that trading strategy. What do we next? Very simple. We simply shift those windows to a few steps forward, or let me do it, I go backwards, and just for simplification, I create a new box now, and I hoped that just a second. So now we would have a new box, and that you can see where that box would be. This new box I would put exactly here. So the green box is now at the end of the formerly red box. And what do we now? We simply iterate that kind of process. So that means now within the green box we do the optimization process. We get new parameters, and in most cases those parameters are more or less the same than within the previous box, but sometimes they might change a little bit. Having those new parameters now, we can apply them once again to the future. The future is now the new shifted red box. So we once again apply our strategy to future data. Those trades would enter into the records as well, and so on and so on. So what we finally do is we always move that box a few steps, do the optimization process, apply parameters to the future, once again. Optimization process, parameters to the future, and so on and so on. Just a second, I get a question here. So now, somebody indicated we have 2 parameters remaining here. That is the length of the green box and the length of the red box. And that is very true, but we can reduce those two parameters ultimately to only one, because the red box can go down to exactly, let's say, 1 day or one trade or whatever. May depend on the strategy. So that kind of iteration process for the red box can go down, let's say, to 1. That would mean that we have to do a lot of optimization, applying, and so on and so on. So, but finally, the red box might go to 1 candle. The green box, indeed, is the one and only remaining parameter we have left, and that is the length of the history, which we take into account for the optimization process. But think about any trading strategy. Any trading strategies might have something between, let's say, 2 parameters or even 6 parameters or whatever. So mathematically, what we do here is we reduce the number of parameters to simply 1. And the one and remaining parameter is the length of the green box. But this is better than having maybe 4, 5, 6 parameters, especially if you think a little bit about the question we discussed earlier in the webinar. Maybe if I would do what has been suggested there, to add maybe additional 4 parameters to a trading strategy, I might have a trading strategy with 8 parameters. Still, I would think this might tend to overfitting, over-optimization. But I will learn if that is true or not if I do that kind of back-forward testing. Because if we still, even if we have 10 parameters to be optimized within the green box, still, if all the trades added up within the red box are good, then I even don't care about 8 parameters or 10 parameters of a trading strategy. So it's more a concept which helps us 2 things. One is to reduce the number of parameters, finally exactly to 1, which still has to be optimized or tested, and same rules apply here. So for example, if I have 250 days as the length of the green box, of course the strategy should not go into the minus if I go from 250 days history to 260 days history. If that would happen, then I would have an alarm signal, so to say. All good strategies would not behave like that. And other thing you will learn if you apply something like that is that because you learn something about the parameters itself, if they change really from day to day, then it might be a little bit strange. Still, even if that is the case, if all the trades within the future box, the red box, are good, even then I would not care about the parameters change very often and so on. So the thinking is different if you apply back-forward testing. The thinking, in a sense, you know exactly what would have happened if you would have applied the same logic, the same rules already in the past, but with a different manner than just doing a back test in the history and then go live with that trading strategy tomorrow. So that's a totally different thing now, because we know from the past what have happened always in the upcoming future. So that is really something very differently. So it's a mighty tool, that kind of concept. Yeah, the drawback, the disadvantage of that concept is simply it needs a lot of computer power, or whatever how you do it, or whether you do it in Excel or so it's a lot of work, because you have always to do that optimization, applying optimization, applying, and so on and so on. So yeah, it's a hard work, but it's very good to do that. So that is a good concept, and that concept, I hope you get a clue of that. If something is missing, you don't understand, just yeah, send me an email, or we may chat about that via Skype or whatever. So a very good concept, at least I think. But now another topic, because I want to introduce something, and I want to invite you to give your hints, ideas to that kind of strategy. That strategy runs here at my table together with a colleague under the name of class trading concept. That might be a nice name, but what I mean with exactly that kind of concept, I will show you with the next comments, and with one example within an Excel sheet as well. So the basic assumption is simply you look to your chart. For example, Euro, US dollar on a H1 base, so an hourly base chart, just as an example. And you might think, whenever candle closes, so we come to 11 o'clock, 12 o'clock, 1 o'clock, and so on and so on. And you might, and maybe you do, exactly that kind of question. What trade should I enter? What trade can I do? And in principle, we have those three answers. We enter a long trade, we enter a short trade, or we go for no trade. If you would do it exactly like that, maybe if you do, let's call it normal trading, in most cases you would decide no trade. And that kind of concept even applies for if you think about, normally you have trades like a buy limit order or buy stop order or something like that. Same question is true here as well, because then I go down maybe to M5, M1, and I can always ask myself the question, should I enter now a long trade, a short trade, or no trade? If you do it by limit orders, by stop orders, it's only that you have postponed or exactly described your decision for a future case. That is something like a stop buy order, because there's just which has to be reached, and then you enter a trade. So it's nothing different. If you say, okay, I want to enter a trade, and then maybe the simplest way to describe the trade you would like to enter is that trade gets a stop loss, a take profit, and let's have a third number, the maximum length of the trade, the maximum duration of the trade. Let's say that just think about if I have trades based on H1 decisions, then I might think, hey, I want to have that trade maximum 1 week. If you need that kind of number, then you might have that, but it's not really necessary. But at least you should have a stop loss and, let's say, take profit for simplicity. So at every close of a candle, you get that question, and we now need an answer. And to get that answer, long, short, no trade, we can try to learn from the history. And simply because within the if you look to the history, we might have what I simply call here similar situations. Since trading in general is the thinking that something what has been good in the past or has happened in the past might be a good idea for the future as well. Therefore, it might be a good idea to look for similar situations which we have. We have a situation right now, and now we look for similar situations in the past. And maybe we can learn from the past what typical trade with, or no trade, with a specific stop loss, take profit, and the maximum duration, in my case here, would give us the answer what to do now. You might think that is a little bit similar to candlestick formation, and the answer is yes, it is. The difference is that I want to use that concept in a more open way or in a more general way. Of course, I know those candlestick formations which give you a hint, hey, I go short, I go long, whatever. But if you do it a little bit more general, we can do much more than those candlestick formations. What we need an, let's say, indicator or a number or something which gives us those similar situations. And what I want to do here is I want to build classes for situation. So think about candlestick formations, then you have a specific class, like three wet bars in a row. I forgot the name, and all those nice formations. Lots of them have specific names. Every candlestick formation would be one class, one trading class. To be more general, we sort all the situations into some. We order them into a box, or we assign them a name, like those candlestick formations. If we have those classes, then we can do our optimization for every class, because all those situations have been similar, and now we try to answer the question, what is a good trade for that specific situation? And this answer we can get from the history. So finally, what we would have is we have different classes with different sets of parameters which describe the potential trade. So first of all, it's a question, trade yes or no, and then long or short. And finally, those three numbers, in my case here, stop loss, take profit, and maximum duration. Let me show you one example of what I mean with classes and similar situations. In this case, the concept is that we look for the movement after 1, 5, 17 and 64 candles. So it's the movement after one is simply the close-to-close difference between those two prices. So the close price from the previous candle compared to the close price of the current candle. And 5 means simply the close price from this candle to the close price 5 candles ago, and so on and so on. You see what kind of numbers I have taken here. Simply the difference first is 4 candles, then I made a mistake. Then 16 candles, and finally 64 candles. So it's 4 times 4, and finally 4 times 4 times 4. From a chart perspective, it might reflect a little bit short-term history, mid-term history, and long-term history, whatever one means with long, short, and mid. Just to have an indication, 65 candles on an H1 base is about half a week. So we look, what was the price 1 candle before, 5, 17, and half a week before. So that is the first step to get those classes. Let me show you what that means exactly. Because I mentioned here, I calculate the movement in units of ATR. So I started my Excel sheet simply with the ATR Excel sheet of a few webinars ago, where we simply did our calculation how to get an ATR value out of our historical data. And we have had 2 examples. One was ATR 24, and the other one was ATR 120. A few weeks ago, I did the calculation ATR in percent, so in percent of the close price. Now I simply switched to absolute numbers of ATR values that is more similar to what you have as an ATR indicator, for example, in MT4. That is only for mathematical reason, because I need the absolute number here and not a percentage number. So we know how to calculate that ATR. Then the next calculation is done. If you look to the formula here, so I look for the movement of the one candle. So I build up the difference between the close price from now to the close price from one candle before. And you see in the formula that I divided that number by the value of the ATR 120. What does it mean? It simply means that I measure the movement in units of ATR. This is a good thing, because a movement is a movement, or is a price change. But whether that price change is big or small has to be seen always in the context of the current volatility. Sometimes 10 bips might be high. Sometimes 10 bips might be low. If you think about 2008, the peak of the financial crisis, we have had huge ATRs. So then 10 bips would have been nothing. But therefore, we measure the movement, so the price change, in units of ATR. So we do it for one candle, then we do it for 5 candles, and so on, 17 candles, and finally for 65 candles. So what you can see here with those 4 numbers, that is the first step to define a situation. Of course, those numbers might be sometimes big, sometimes small, and so on and so on, but something like that can create typical situations. It's a little bit like candlestick formations, but now a little bit different, because we don't look for 3 candles in a row. No, we look for the difference from now to 1 candle backwards, 5, 17, and 64 candles. Since we know that typically the higher the number of candles we look into the history, the higher is the movement. You might remember from last webinars that we learned that there's more or less a universal general price-time relationship, so typical price movement versus time, and that was the square root behavior in time. So if we double the time period, we only have typical movements with a factor of square root of 2, so 1.4 in this case. So now, therefore, we have to normalize a little bit our data. Normalize in a sense that we know, of course, 65 candles have always high numbers, or typically have higher numbers in movement than a 1 candle movement or 5 candle movement. So I do that kind of normalization simply by applying that square root time behavior. What does it mean? Since 1 candle has not to be normalized, therefore I divide my previous result simply by 1. In the next case, because now I have 4 candles period, I divide it by 2, so square root of 4. And for the 16 candles, I divided it by 4. And finally, for the 64 candles, I divide that number by 8. This normalization brings me back to typical movements, because I know that for higher time periods, I have higher movements. So that is simply a normalization process in this case here. And then I can build up my classes. And classes now means I assign those number of movements, normalized movements, now only a number which has the values 0, 1, and 2, nothing else. How do I go to those 3 numbers, 0, 1, and 2? I have a threshold for that kind of class building. In this case, simply 0.25. I can change it. And if you look what I do here, then you can see that I compare my normalized movement with that number. If my movement is higher than this threshold value, then I assign a 2. So class number 2 for that number. If my normalized movement is below, so smaller than minus that class building number, then I assign a 0 to that value. And if it's something in between, it goes for 1. So that's all. And so for every movement, 1 hour, 5, 17, 64, I get a number in terms of 0, 1, and 2. So every movement is now sorted into 3 classes, 3 sub regions, and they simply get a number, 0, 1, and 2. I do that for all my history data, also for all my history of a current price. And in this case, for the first case here, I have the combination 1, 2, 2, 2. And what I can do now is I can simply calculate a class number. That's only for technical reason. Technical reason means I want to have one situation assigned to one number. And in this case, for this first example, I have the number finally 79. It's quite easy to calculate something like that because I only have to take my 4 numbers of my subclasses and then multiply the last one with 27, 9, 3, and the first one with 1. And then I have this kind of assignment to every candle. So every candle has now a specific class, a specific what I call situation. So the task was simply to assign a current candle to a class number. And that is something a little bit similar to what you might do if you trade just by looking to your chart. You might have something like your own, let's call it decision matrix. Something like you first look to what is the current volatility. Is it high? Is it low? Is it midterm? Then you might have a look, hey, what was the situation 2 weeks ago? What was the situation 3 days ago? And what was the situation 4 hours ago with my current underlying? That is something you have in mind as well. Then you might have an indicator like an EMA 200 within the chart. And you look for, hey, is the current price below my EMA? Is it above? And so on and so on. Looking to that, what I described verbally, is nothing else than building classes. Because what you try to do when you have that kind of decision process for entering a trade is exactly the same than building those classes. Because you might have different strategies, different typical trading setups for those different situations, like high volatility, low volatility, trend behavior, high slope in your EMA, prices above, prices within the range, and so on and so on. All those of inputs build your own classes in your own thinking, and then you might enter a trade, a short trade, a long trade, and so on and so on. You might have typical stop losses for those kind of situations. What I do here is nothing else than formally to get that kind of process to a mathematical background or to a more mathematical description. But it is finally the same like what might trigger a trade when you look to a chart. In my case, I have only 4 numbers, and those numbers boiling down to just 3 states, and the states are 0, 1, and 2. So reflecting something like in my wording about volatility, low, high, and something in between. So, of course, I can use more numbers. That is absolutely not very tricky, and I can do. But what does it mean? Then I get too much classes. Why do I have those numbers like here? I can tell you. I know typically when I go for an H1 strategy, and I look, for example, to 10 years history, the total amount of candles is then in the range of 80,000. In my case, here I have 81 classes, finally. Those 81 classes I want to optimize individually now. So if I do my class separation, let's say right, I might have within every class, finally, 1,000 candles. Because I have 80,000 candles history, and I have, let's say, 80 classes. Therefore, I have within one class exactly 1,000 candles. If I would have 1,000 or let's say 800 classes finally, then I would have only 100 candles within one class. And that might be a little bit low to apply statistics. If I do it like I have done here, I can show you that my classes are more or less distributed homogeneous. To prove that statement, I can use a nice Excel trick. I simply take all my class numbers here. I take them, I put them in the sheet here and in there, so I copy them here. And next step is I simply sort those classes by number. And instead of applying a histogram, which would be the normal or the real tool now to see whether those numbers are distributed homogeneously, I can simply plot them here. And if you more or less have a straight line within that graph, then you know your distribution is homogeneous. So within every class are more or less the same number of class members. And in my case now, yeah, it looks a little bit like a straight line. And even if I change my number of that class building number, in my case it was a 0.25, then that changes the picture of distribution of my class members quite a lot. And by the way, that number 0.25, I decided to go for that number because then my class distribution is a little bit homogeneous. So that is a concept of class trading. But now my invitation. My invitation is simply, you might have additional ideas of how to build or to create those kind of classes. You might just think about the full set of indicators you have within any chart software tool. Of course, yeah, that might be something, but try to think a little bit more from your personal experience about trading. You might have seen some typical situations and which enables you to create profitable trades. And if you have something in mind like that and you can describe it a little bit, yeah, then just send me an email, because I can use those classification, those indications. I don't want really to call them indicator, but of course it might be indicators as well. Just as an example, if you think about the indicator RSI, then this is an indicator with numbers between 0 and 100. Of course, I can do more or less the same. Hey, per current price between 0 and, or the indicator between 0 and gets a 0, and so on and so on. So we can sort those things into classes by classical indicators, or for example, in my case here, whoops, different movement after different time scales. So that is, yeah, an indication as well. So whatever you have in mind, just send me an email. I will try to make something out of that. I will do, of course, something out of what I have here as well. I know that we can do some profitable trading strategies out of that that I know. And by the way, just that what I talk here is not that theoretically. Just as an example, because I trade already a strategy with that kind of indication or that kind of base. In this case, it's already done on an M5 case, so I have more candles, more statistics, more, and I can apply more classes in this case because I have simply more candles. And yeah, that strategy is already up and running. And only to give you a short impression, I don't mean, okay, the strategy is in plus, in equity, in balance, and current profit and loss of the ongoing trades. So you might just, if you look to, in this case, for old trades, closed trades, you see in the comment here, okay, they are always assigned to class numbers, M560 and 73, and so on and so on. So that is exactly what I have done. I know for every class a set of parameters, and then those set of parameters will be applied for a potential trade. So sometimes there are more trades, sometimes less trades, and just have a look whether there are trades from the near past. Yes, just 8 minutes ago, there have been a new trade for US dollar, Japanese yen, and it was a trade because that was assigned to class number, and so on and so on. So this is a nice basic concept for trading, thinking in classes, so in situations, because that is similar to what we do if we look to a chart. Then just looking to a chart might be something similar to what you do normally. Just as an example, because I think an hour ago we have had a strong movement within euro, British pound. If I know something about similar situations in the past when I have that huge move, I know what to trade now, or maybe I know it's better not to trade now. So that is meant with those situations or those kind of classes. What you see here, by the way, is exactly what keeps me busy exactly right now as we speak. So that is the latest kind of strategy. I'm still in the developing phase. So it's exactly my current task doing those kind of strategies on different time scales and different kind of classes. This was only an example, but I know there might be a lot of other good ideas how to create and name situations. And what I mean with situations, I think you should have understood now, I hope at least. And if you have a good idea, just send me an email how to separate situations by certain indications. So yeah, that's for now. Oh, 1 hour is already over. Oh, that's not from this. It's this one should be the final slide. So still, if you have questions, just send me an email, friedrichowski@argus.com. Of course, many thanks to Argus who make that kind of webinars available. Yeah, if you have questions about Argus, Argonaut platform, you know the contacts and how to reach somebody, or simply just send me an email. So that's for now. Hope you enjoyed the time, and yeah, maybe see you again exactly next week, same time, same place. Have a nice day. Bye bye.